Hello CQA judges, we are Marquette Team 2. We are all juniors of the Applied Investment Management program here at Marquette University, where we manage $2 million of the school's endowment. I'm Jack Gorski.
William Reckham.
Jordan Luchak.
Connor Konecki.
James Hannick.
Here's a brief agenda of what we will be covering today. First, we will introduce our investment team, and then we will talk about our investment philosophy and the process we use. And then we will talk about our portfolio construction/trading, our risk and return expectations, our portfolio attribution, and finally, our portfolio performance.
Our CQA team consisted of myself, Jack Gorski, majoring in finance and economics, James Hannick, majoring in finance and accounting, Jordan Lusig, majoring in finance and economics, William Reckham, majoring in finance, and Connor Konecki, majoring in finance and accounting. We are guided by our CQA mentor, Thomas Anticini, and our Marquette professor, Bill Walker. For our portfolio, our team was interested in creating a momentum strategy that would successfully be able to produce high returns over the course of the competition. Through backtesting and academic research, we recognized that stocks with high momentum also possessed low volatility. This realization led us to the construction of our first model factor, the standard deviation of price returns. With this factor in place, we then began testing the model with the addition of many other potential factors. We noticed that every time we included a price to book and total debt to equity multiple in our model, our annual returns went up. Therefore, we chose to apply all three factors adjusted by a multi-factor weighting system with weights 1 for standard deviation, 2 for price to book, and 1 for total debt to equity. From here, we categorized the stocks into their sectors, ranked them from highest to lowest, and then shorted the top 2 stocks for each sector and bought the bottom 2. We made this decision after backtesting the model over the past few years and recognized that purchasing the top stocks generated substantial losses. Once we had our stocks selected, we chose to buy them on an equal dollar weighted per sector.
My name is Connor Konecki, and I'm going to discuss our portfolio construction and trading. When constructing our portfolio and executing trades, our team looked at macro factors that would have significant impact on sectors. Initially, we desired to minimize our sector bias because of potential market risks heading into the election. Our initial portfolio was running a negative beta, which in turn went against market conditions post-election. This resulted in our team being down 3.5% within the first month of trading. After markets continued to rise and the election shock settled, we made strategic trades in the first week of December. We looked to cut all short positions in the financial industry and only have positive outlook in banks and other financials, given potential interest rate hikes and Donald Trump's talk regarding the deregulation of banks. Due to the highly negative beta and bull market, our overall portfolio went against market conditions, which caused negative returns. Through December and January, we executed trades in an attempt to adjust our beta to become slightly positive as markets continued to rise. To do so, we cut long exposure in sectors that were having negative growth, like oil, gas, and energy, while increasing long positions in volatile, growing sectors like financials and healthcare. These trades start to gain momentum and reduce our negative returns. Since the start of February, we were able to eliminate our negative returns and finally produce positive numbers. Over the course, the biggest factor to our success in portfolio construction and trading has been the high conviction we had in our model. We knew the potential through backtesting and wanted to remain committed to our model with minor adjustments to certain sector exposures given the macroeconomy. We look to play it safe in times of extreme uncertainty by remaining sector neutral around the election, and then look to capture growth in areas the probability and uncertainty of trends were favorable.
I'm William Reckham, and I'll explain our team's risk and return expectations. Within our portfolio, we had approximately 1/3 of our weighting attributable to factor risk, also known as systematic risk. This risk is dependent on the overall market conditions, such as macroeconomic factors. We wanted to try and attain more than 50% specific risk. This risk is independent of general market conditions and unique to a particular security. We believe this structuring of our portfolio has given us a competitive advantage against other teams. Overall, we created a beta that is slightly negatively correlated to the market, which was negative 0.06 with a total and active risk of 7.02%. Through this configuration, we have currently generated positive returns.
In regards to our portfolio attribution, the following graph shows the return by sector for the stocks that we had in our portfolio. Our leading sector was industrial goods, followed by strong performances from the services and raw material sectors as well. On the flip side, the two sectors that posed negative returns were consumer goods and healthcare. With that said, due to recent announcements of banking regulation repeals, we feel as though going forward, by the end of the competition, our portfolio will be experiencing much larger returns in the financial sector. Moving on to our next slide, we show the best and the worst performers of individual stocks in our portfolio. As can be seen by the tables, what sector the stocks were in had very little bearing on the performance. However, what can also be seen is that 4 of our 5 best performing stocks came from long positions, whereas all 5 of our worst performing stocks came from short positions. This falls in line with the bullish performance of all major stock indexes since the beginning of November.
I'm Jordan Luchai, and I will be outlining our portfolio performance. Initially, we had a lot of faith in our model, but after the first month, we are starting to get discouraged. As you can see in the graph below, which compares our portfolio returns to the Russell 1000 index, we saw a drastic dip at the very beginning of the competition. We attributed a lot of this decline to outside factors such as the election, and soon we saw our portfolio start to crawl back. However, our portfolio returns never aggregated how we had hoped. This led us to review our model and other macroeconomic factors to see if there was any way we could improve. We still had the utmost confidence in our model, but we feared that maybe we were not allowing ourselves to have enough weight in sectors that were due for growth. Over winter break, we decided to reconsider our sector neutrality. We continued using the same model, but decided to pick more of the stocks that ranked higher on our list rather than focusing on what sector they were going to contribute to. After this small alteration, we stayed steady for a few weeks at around negative 2.5 to negative 3%, and then we finally started to witness the types of returns we were hoping for. If you look at 1/25/2017 on our graph, you can see where we began to accumulate more positive returns day over day and finally get into the green, and eventually maintain positive overall returns. We had multiple companies go up 20 to 30% in this span, such as Alcoa, Southwestern Energy, and Liberty Broadband Corporation. Earnings season was also very good to us and propelled our portfolio into the top 10 rankings over the last couple of days. And as you can see, we are currently exceeding the Russell 1000 benchmark, as well as maintaining solid standing in each of the Sharpe ratio and alpha beta rankings. We want to thank you for taking time out of your very busy schedules to review our portfolio and for allowing us to take part in this prestigious learning opportunity. Thanks again, and have an amazing day.